Also, political reporting that Presidents Trump and China's Xi will meet in the first week of April in what could be the first of 4 meetings for the two this year. So let's bring in Dwardrick McNeil, Senior Policy Analyst at Longview Global and a CNBC contributor, and Mark Chandler, Chief Market Strategist at Bannockburn Capital Markets. Gentlemen, great to have you here. Dwardrick, I'm going to start with you, because obviously a lot of headlines in the last 24 hours regarding U.S.-China relations, but it was very interesting to me how much the Treasury market seemed to shrug off these reports about Chinese banks being told to limit their exposure here. Just lay this out, especially coming off of last week, where Ray Dalio sat down with my colleagues at CNBC International and made a lot of news talking about the fact that we are on the cusp of a capital war.
Yeah, well, I'll tell you, it was interesting to me how quickly this was shrugged off. And I think largely that's because in the near term, this was very moderate guidance. It wasn't the PBOC. It was to banks, and it advised them to not buy any more, reduce exposure that they may have. But I'll tell you, Morgan, this is Beijing continuing what has been a gradual effort at financial de-risking, trying to limit their exposure to dollar volatility. But for the longer term for China, it's sanctions risk if there were ever to be any sort of conflict. Think about Taiwan, for example. So I think there are certainly longer term reasons to be concerned. In the short term, I guess I understand why markets may shrug it off.
Mark, I want to get your thoughts on this, especially since there's been so much debate and speculation about de-dollarization and debasement trades and how trade wars are playing out in financial markets overall over the last, call it, year.
Yeah, no, you raise a good point, Morgan. I think that, you're talking about a little impact in the U.S. Treasury market, and here we are with the 10-year yield having closed only one day before today, below 4.2% on the 10-year yield. So I agree, while the bond market didn't take much notice, I think the market took much more notice in the foreign exchange market, where the dollar got hit across the board, even after the Japanese Prime Minister landslide victory in Tokyo over the weekend. The yen, which had been expected to weaken, strengthened. The dollar was broadly weaker, and I think this plays on the fears, like you're saying, about debasement. I think many people agree with me that over the past year, the U.S. has lost some element of trust among our allies and among investors, and a modest move away from the dollar. That's what we saw. Rather than sell America last April, it seems that people were selling the dollar as a hedge while holding on to U.S. assets.
All right, I want to dig into that a little more deeply. But first, Dwardrick, I mean, we saw it last year, the leverage that China was able to exert with, rare earths and other critical minerals. And we've seen the U.S. move very quickly, very aggressively, and with some deals very unprecedentedly to start to counter those supply chain risks, which I realize are still going to take some years to stand up here. But when you look at reports like this ahead of a meeting between the two presidents, how much should be read into early negotiations and a flex of leverage here as well?
Well, I think this is certainly, Morgan, what I call leverage signaling. It is meant to suggest that in addition to critical minerals, which we've seen, that China has other leverage points. We talk frequently about pharmaceutical precursors. We talk about being able to control certain points of the supply chain. But I think it's important to note here that China is saying that financial dependence cuts both ways. And so this is a chance to really, what I call, again, leveraged signal to the U.S. on this issue.
Mark, to go back to your comments before, I mean, the administration's been pretty vocal in saying that they're not opposed to a weaker dollar, that they think the dollar has, for a long time been overvalued here. That being said, some of the moves we've been seeing in the currency markets, whether it is the yen strengthening against the dollar on the heels of that historic election, whether it is the strength of the euro and the pound versus the dollar too, have those moves surprised you? And I guess longer term, how to understand them and how that ripples out to other asset classes as well?
Yeah, Morgan, I think there's two things going on. One is a cyclical move. I think you're right. The dollar is overvalued on most measures. And so some modest pullback in the dollar seems reasonable and consistent with what the administration wants. On the other hand, there's something else, I think, more structural going on. And I think that's not only what China has signaled, but we have seen the dollar's role as a reserve currency ebb. And I think that where countries have a discretion, of course, when they're trading oil or soybeans, they have to use US dollars for the most part. But I think where countries and companies have discretion, they're trying to move away from the dollar. And what caught my eye this morning was Alphabet, a 100-year bond in a foreign currency. I don't think we've seen that, at least not since maybe Motorola's days. So I do think that there's something more profound going on, and I think that the problem, and this goes back to the critical earths, is that the U.S. consumption, our defense, is based on supply chains that the U.S. doesn't control. Mm-hmm. We pretended we controlled them, but we don't control them. And that's what concerns me, and I think a lot of investors, is the U.S. is abdicating from the global order that it helped create, and it's shooting itself in the foot for the next world order, which seems to be, maybe it's critical earths, maybe it's AI, but I think that many people are afraid that the U.S. is slipping behind.